Investor Television, because you're worth it.
So it sounds to me like you use a combination of fundamentals and technicals. What percent would you say when you're making a decision, what percent of your decision would be based on fundamental information, and what would be based on the market technicals that you mentioned last time, like volume and chart patterns?
Well, I mean, I really don't have a defined formula that 30% may be fundamentals and 70% may be chart patterns, but typically if the fundamentals are very good, then the chart patterns will be very good. So, you know, they kind of go hand in hand. You know, typically if I find a stock that has powerful chart patterns and really explosive behavior, underneath you'll find a stock that really has tremendous fundamentals. So they just kind of go hand in hand. I definitely, even if a stock has a super chart pattern, I probably won't buy it if earnings are up 25% and revenues up 25%. Stock just really has no place to go.
Now, obviously trading is a situation that you're learning all the time. What would be your biggest single lesson, do you think, in 2005?
Not to be in the market all the time and to trade far less than I do. Far less. I mean, I really have found that the market may have two big moves during the year. They may last 6, 8, 10, 12 weeks. And other than that they just exhaust themselves after that. And really, the rest of the time, the market is just consolidating the gains. So the big lesson for me this year has been, you know, just to trade less. Trade less, trade fewer stocks, own just about 4 stocks that are really powerhouse stocks when the market bottoms out, and then the market will take off and run for maybe 10, 12, 13, 14 weeks, whatever it does, and then just trade out and then go to golf, go to swimming, you know, go to cash, just have fun and enjoy and wait for everything to set up and do it again. It takes about 4 to 5 months for everything to set up again.
Great. Now, what keys do you look for a market that may be bottoming, and you never know until after the fact, but what are some of the things that really give you a heads up that the market's about to take off?
Well, I mean, leadership stocks will be sitting near new highs, such as a Google, while the market is looks like it's cascading down and almost in an inverse parabolic-like curve. And then you'll find Google sitting near new highs, like what we see it now here in October of 205, or it could be something like an Apple sitting near new highs and making new highs, or a SanDisk, stocks with new earnings, powerful earnings, not new earnings, but powerful earnings that'll come out, and then the stocks will explode. Meanwhile, the market is still trying to grab its legs, and the market will lag these leading stocks. Hence, that's why they're known as leaders.
So you'll look for 3 or 4 or 5 market leaders. You'll watch for them to break out on powerful volume, making powerful moves, gaps up, and then you'll wait. Basically, the market will have to play catch up, and then you'll all of a sudden see the market playing catch up. And is that when you jump in, or do you jump in before you see the market respond, like the NASDAQ composite, for example?
Well, again, I think that the market is a lagging tool. So if I'm going to wait for the market to take off and break a trend line or break through a resistance point or something, my leading stocks have already gone. So again, the leadership stocks are leading, and then the market will get up and follow that leader. So I focus in on the stock first, the leading stocks first, with the big earnings. And then again, right, if they're gapping up on earnings and the market's collapsing, these are stocks that I want to focus in on.
Okay, that's great. Now let's break it down onto a daily basis. I've watched you trade. It's very exciting. Can you just give us sort of a brief summary? And I know this is probably tough to do, but a brief summary of what you're looking for. How many stocks do you watch at a given time, and what you're looking for to give you a key that there might be a breakout?
Well, I'm following about 60 stocks during the day in my e-signal program, and you know, I'm really not doing any charting at the time. It's just on my quote monitor, and I'm just looking for surges in volume. I'm literally scanning for surges in volume on a stock and seeing how it responds, and if a stock is breaking out of a pivot area, as we would call a basing area of some sort, has powerful earnings, and you know, for me it has to be really a big global product. And Apple is global, Google is global, SanDisk, even though the name is not well known, they're making products that go into these global products. These are powerful stocks, and this is a criteria that I need to see. And when they make their big move on volume, then I'll go ahead and make my move. I want to go with the institutions when they go.
And what are some of the cues that the institution guys are moving? You start to see volume, or what else do you see?
Well, I see massive volume, not just petty volume. You know, if a stock is trading 4 or 5 million shares a day, all of a sudden it starts trading 15 or 20 million shares a day, and the stock's leaping $3 and $4. And this is for me is the the percent change in volume is really one of the big keys to finding the big winners and following the institutions. They're just not afraid to really pile in hundreds of millions of dollars on a trade to get into that stock. And if they want it badly, I want it badly. And if they don't want it, I don't want it. It's simple as that.
Is there any percentage you look for? What percent above, say, the 50-day moving average of volume? What kind of percentage volume do you like to see? Would you like to see 50% above that, or 150%?
Well, I don't use any 50-day moving average volumes, but I use like a 20-day average that you run on eSignal. So if the daily average is 4 million and the stock's trading 4 million after 2 hours of trading in the day, obviously the stock by the end of the day could be running 16 million shares a day, so or 12 million shares a day or whatever. That's the kind of percent change I'm looking for. Change of 300%, 400%. 600%, whatever it is, it's got to be huge, and the stock has to be breaking out. And I'm looking for the market to be oversold as a general rule to start getting into these big moving stocks.
Okay, that's great. So you use volume. Now, some of your chart patterns, you've talked about head and shoulders patterns, you've talked about flag patterns, you've talked about pennant patterns and cup and handle patterns. Can you just give us a brief outline of maybe some of your favorite patterns and maybe some examples of some patterns you've seen over the last little while, or something that you've traded? For example, eBay, maybe go through that one. What kind of patterns tipped you off that eBay was about to break down?
Well, it had a high-level channel base of about 3 weeks, a very small base. If it's a small base, it's weak. It broke south of the high-level channel, and then it created a bear flag, which is the opposite of a bull flag. It's inverted. It's upside down. The stock makes a break down and then moves horizontal for a while, and then it should be a continuation to the downside, should be the next thing. So it had a decelerating earnings. Earnings were 80% 3 quarters ago, then they were 60% last quarter, and this quarter it was going to be even less than that. So you have a very high PE stock with decelerating earnings with a very bearish pattern. It just all adds up, and the market had already had a very long run of 3 or 4 months, and all added up to a stock that was just headed to make a significant break.
So it sounds like you have a pretty exciting vocation.
Well, I love it. Boy, I wouldn't trade it in for the world. Every day is just absolutely thrilling, and every day is new. It's exciting, filled with lots of spills and chills, I'll tell you, But, the rewards are absolutely phenomenal. When you get it right, it takes years and years and years and years of learning and hard work and 15-hour days, a lot of ups, a lot of downs before you can get to put the whole package together. But, if you do the homework, you really study bright, hard, long hours, you just stay focused, get rid of all the stupid indicators out there, all this MACD stuff and volume accumulation and money flow. I don't use any of it. It's totally worthless. It's price action, it's volume, it's chart patterns, it's spectacular earnings, and that's all there is.
Okay, for somebody watching out there today who this may be totally new to an investor, maybe who's been frustrated by the investment returns, or looking to really key up their returns, or maybe someone who's a new trader, have you got some advice, maybe some resources, some books they might want to read? I know you have some favorite books you like to talk about in your seminars.
Well, my favorite book is How to Make Money in Stocks by William O'Neill. For me, it's the stock Bible. Many chapters in the book. I mean, I probably read the book front to cover maybe 6, 7 times for the first 5 or 6 months of my trading, and then I read selective chapters probably 30 times after that over the next 6 years, constantly hammering into my mind how to trade, what your mistakes are. You just can't do this. This is going to be wrong, and over and over and over and over again for 6 years. It just constantly changed in my mind, my thought patterns, what I'm looking for. And after a while, it was just, like the light really came on. I started making incredible amounts of money, and then the bubble hit. And that's the internet bubble in 1998. And that's really when things took off for me. Up until then, it was a brutal learning curve. A lot of ups and downs, making money, losing it, making money, losing it, and then finally putting it all together. And then the bubble hit, and it was just the right trader with the right mentality, the right trading tools, in the right market environment. And we already know what took place. The tax returns are I've been audited. I've been in Fortune magazine, Forbes. I've been on Extra TV. As a result, it's just really been phenomenal. But again, I mean, you can't imagine the amount of hours that I put in. Weekends, 8, 10, 12 hours on weekends, for 3, 4 hours after my regular job. And, but it takes a long, long time to put the whole package together.
Okay, so besides William O'Neill's How to Make Money in Stocks, what are some other books that really have to be read by people who want to understand how to trade chart patterns?
Well, I obviously think that the Jesse Livermore book is critical, really teaching you how to identify when to get in and when to get out of stocks. Trading fast-moving stocks in particular. Don't worry about expensive stocks. They're probably the biggest money makers in the market, percentage-wise. Those are really the only books that I've really ever read that have had an impact on me. I think everything else is just a lot of fluff.
So is that I believe it's called Reminiscence of a Stock Operator?
That's correct. That is correct, yeah. Fabulous book, quick, easy read. O'Neill book is quick and easy. They're just, if you read it once or twice, you don't go back to it, don't lose your day job because you're going to need it. You really need to read these over and over and over and over again until, you just know it inside and out. So when you see the situation in real time, you know how to react.
Now, okay, so the chart patterns, though, they sound fairly complicated. Is there somewhere or some place you can go to learn about chart patterns or read about them? Is there a course you can take, or how do people learn all about chart patterns and how chart patterns react with volume?
Well, obviously, I think the best place is my website at chartpattern.com. That's singular, no S at the end of it, and I put a newsletter out 4 nights a week highlighting the big movers like your Google or your Taser, your Research in Motion, your Apple or your SanDisk. Put the newsletter out 4 nights a week highlighting and giving you the big ones. So I'm leading you right to the water. I can't make you drink. But so I'm showing all the different patterns out there that the stock market has of which you can buy from stocks. Descending channels, ascending channels, flags, wedges, pennants, cup and handles, head and shoulders, all kinds of crazy stuff. And we utilize these for buy points. And obviously the stocks that I'm showing have the big revenue numbers and the big earnings numbers that go hand in hand with it. So it's an explosive situation, and that's what we're looking to exploit. Explosive moving stocks.
Yeah, I'm familiar with your newsletter, and it really is good because as I see it, it's training in the trenches. You're actually seeing stocks break out. You talk about them before they break out, and it's exciting to actually watch them break out, especially if you got money in them, correct?
Oh yeah, nothing more exciting than when you have the money in them. That's when you really begin to follow them, and you really don't learn anything until you have a few bucks on them. And again, if you're new to this, I would not have a whole lot of money until you go through a few cycles. Maybe you try this for a few years because there's a lot of ups and downs, a lot of traps. The market's not here to give you money. The market's here to take your money. So you have to learn to play with the pros. They'll rally the stocks to sucker you in. Your emotions will get you in. The next thing you know, they pull the rug out from under your feet. So, and then you're selling way too late, or you're holding too long, and it continues to go down. There's so many pitfalls in the market. The market is designed to shake you out of your cash. Once you get the routine down and how they're trying to shake you out, then you can be in front of them. And that's what the game is all about, is being in front of the institutions.
So for somebody starting out who maybe be frustrated either investing or trading, do you buy the less expensive stocks because they are less, you don't have as much money, or what's your advice on buying cheap or expensive stocks?
Well, I never made money in the stock market until I quit buying cheap stocks, and always focused on buying the most expensive stock in the market. Right now I always focus on $60, $80, or $100 stocks, and if I can find a $150 or a $300 stock like a Chicago Mercantile Exchange trading at I started playing with that stock at 200 a couple of months later. Now it's at like 370. Had some ups and downs on the stock, but that stock has made a spectacular move. Google started out at 100 basically, plus or minus a few bucks, and now here it is at $391 a year later, and it's had some spectacular moves in between and some long horizontal consolidations. But boy, when these things get up and run, you can just plow your money into it. Now remember, you're going to buy fewer shares, but you're looking at your percent. So if Google makes a 50% run, like it did from 200 to 300, that's a 50% run. You're on margin, you made 100% on your money. Now if the stock turns and starts to break down, you may lose 3 or 4% on your money. So your risk-reward ratio is enormous on the expensive stocks, and these are the real quality stocks, and they make huge runs for long periods of time.
So if I read what you're saying, don't make the mistake of buying stock because it's inexpensive. Buy a stock because it's the one that's actually got the greatest potential for making a big move.
That's exactly right. The old saying is buy the best merchandise you can find.
So you want to find the market leaders, dominant, dominant in their space, with quarter over quarter earnings increases, and stocks that basically own the space, are leaders producing new products, new services, new management. Is that correct?
That is correct, and it's basically known as the Can-Slam formula by O'Neill, and it's absolutely brilliant. And I just have to hand it to O'Neill. The guy, did all this research work in the '60s and wound up wanting to know why a stock made a spectacular run of 500 or 1,000%. So he would go back and find out why that stock made the big move, and now he's classified this as the Can-Slam formula that he's come up, and I'll be damned, it works really well. Really good. So I focus on those stocks, and then I use my own trading style using my chart patterns and my key reversal bars and stuff like that to really enter and exit the stocks.